Cool. We are officially recording on Zoom. Let me get the other recorder going. On this week's episode of the podcast, nobody likes life insurance. So welcome back to this week's episode of the Crushing Debt Podcast. My name is Sean Yesner with Yesner Law, and this would normally be the point where I would tell you that my law firm sponsors the Crushing Debt Podcast, but we've got a fantastic announcement this week. We are happy to have a returning guest on our show, Chris Calandra with Elliott Wealth Management Services, and Elliott Wealth is now the sponsor of the Crushing Debt Podcast. So welcome, Chris. Welcome to the show again.
Thanks for having me on again, and I'm really excited about the sponsorship. It's a little outside the box for us as a firm. We do not do a lot of sponsorships or advertising. In fact, we've never done a sponsorship, but having gotten to know you a bit over these last bunch of months and have become an avid listener of the Crushing Debt Podcast, I thought it was a wonderful fit, and I'm really excited about it.
Yeah, and I agree. I'm very appreciative. I do think it's a great fit for my listeners, for my audience, for our audience now. To give people a little bit of background, so you were on episode 157. We were talking about wealth management. So this episode will be coming out maybe 5 or 6 or 7 episodes after that. But you were on episode 157 talking about wealth management. Elliott Wealth Management Services is a comprehensive financial planning firm. You are an independent advisor, so that means you're not tied to sell any one specific product. You have a choice of many, many different products, many different investments, right?
That is exactly right. And it's one of the advantages we have in the marketplace, Sean, because we have no proprietary relationship. So when we are speaking with clients, regardless of the topic and the goal, we're completely independent. We do not have a mother firm that would like us to market their manufactured products, be investment or insurance products. So that independence, especially in today's competitive marketplace, is a huge advantage.
Yeah, and so you can place people, or you can recommend what might be the best fit for a particular client, not necessarily what, like you said, what the mothership is telling you to sell.
Absolutely. And in a situation where we have in the United States today, where things are changing at a fast pace, driven by competition, by regulation, by technology, it's also advantageous because if something new or improved comes out, that independence allows us to quickly shelve what we were doing before and adopt the new, better version of what's available. Whereas if you have a proprietary relationship, that company may be great, but they may be slow to adopt a trend in the marketplace, and you then could fall behind the competitive curve. That's not going to happen with our independence. Right.
So, and I know that this applies over the spectrum of financial services that you offer. However, specifically in terms of the relationship between Elliott Wealth Management Services and the Crushing Debt Podcast, what you're promoting to our listeners are life insurance checkups, specifically a 15-minute free life insurance checkup. And so if that's something you're interested in and you're listening to the show, go to elliottwealth.com. There should be a button on the page that says Life Button. Click on that button, and then you'll get a free 15-minute life insurance checkup. So Elliott Wealth, ELLIOTT Wealth, WEALTH.com, elliottwealth.com, and then search for the Life button on the page there, and that'll get you your free 15-minute life insurance checkup. So like I talked about, like I just said, and like I talked about in the title, in the introduction to the episode,
yeah.
Nobody likes life insurance. And I can tell you, the only reason that I don't like life insurance is because in a majority of cases, they make you go through that physical exam, and I'm scared of needles.
Okay.
And so I remember thinking to myself, when I first got licensed by the Florida Bar, there was some life insurance that I could buy, and I did. And then And that was all I had for years and years and years and years. That's all I had. And every once in a while they'd say, if you want to pay a little extra, you can get a little extra more. And I know in the life insurance industry, my dad tells me every time they offer you more, take it, because you never know when you're going to get to the point that you may be uninsurable for some kind of medical issue. But it wasn't very much. It was enough that would have covered burial costs. It would have given my heirs, who at that point, my sister, my parents, whatever, would have given them some money, but it wasn't really a lot. And then I got married, and then I started having kids. And then I decided, okay, now it's time to really get serious about my life insurance. And I remember sitting there on the couch where they were poking and prodding me to take blood, thinking to myself, the things you do when you're a father.
Yes, absolutely. You bring up a couple of good points if I could touch on. And first off, congratulations for recognizing that when you got married, when you had children, that there was now someone or a couple of people in your life that were financially counting on you and would suffer a significant financial loss if something happened to you.
Well,
and the primary,
although I hate to interrupt, I am worth more dead than alive now.
Yeah, you and I have that in common. So the primary purpose of life insurance is to protect someone against a financial loss if there should be a crisis like someone passing away. And the reality is that 41% of Americans do not carry life insurance. And then there's a whole nother contingent that only carries the basic group policy through work, which is basically one-time salary. So let's say that you're, we're both husbands and fathers. Let's say you're a husband and a father and you're working and you make $50,000, $100,000, $200,000, whatever, and you passed away and your family got 1 times your salary. Boy, I would venture to bet that your family has an enormous financial crisis, aside from the wife losing her life partner, aside from the child or the children losing their father. Financially, they now have a big problem. And nobody likes life insurance. It's morbid. I don't like to talk about me dying. I don't like to talk about you dying or anyone else. But when you have people that are counting on you, I firmly believe it's an enormous responsibility to make sure if something bad should happen, as a husband, as a father, I do not want to leave a financial mess behind. I don't believe that's right. I think most people agree with me when presented with that kind of discussion, honest, open dialogue about the subject. But again, nobody really likes life insurance. But if you have somebody that's counting on your financial wherewithal and your income, then life insurance should be strongly considered, in my opinion.
Yeah, and I have a practical example for you, actually, to learn from mistakes. One of my earliest episodes, I think it was episode 9.
All right.
I can't even listen to my first 10 to 15 episodes. I can't listen to them anymore. But I believe it's episode 9 where I tell the story, and I know I've done it on my blog as well. I have a really good friend of mine. When I first started, I was an attorney in Miami, and I became friends with one of the other legal assistants at the law firm, and her husband and I became really close. I was in Miami. We bought Dolphins season tickets together. He was a University of Miami fan, which means he never went to the school. And I was a Florida State fan, which means I graduated from Florida State. And so we were always at each other from that perspective. But he became a really, really good friend of mine. He ended up passing away very, very young, early 30s. And this must have been, maybe it's 8 to 10 years ago. He ended up passing away, and he had his wife and he had 3 minor kids. And through work, he had a $10,000 life insurance policy, and that's it. And the story that I tell in the podcast and in the blog is how we went on, and he was alone on the note, and him and his wife were on the mortgage. Him and his wife were on title. But because he was alone on the promissory note, now I had to go in and go through all these legal machinations to get the loan modified. And we were successful in getting the loan modified, and we did save the house. But, imagine if he had enough of a life insurance to pay off the house, and then we wouldn't have even had to worry about it when he passed.
I agree. And what I'll add to that, and I know you have an awful lot of millennials that are listeners to your show. Of course, it cuts across different age brackets, but when millennials are surveyed, by a long shot, they are the worst at guessing the costs of life insurance. So I'm a big believer, Sean, in term insurance. Philosophically, throughout my 26-year career, I have believed that the best course in the overwhelming majority of instances, people should buy term insurance and invest the difference. You need protection, get the least amount of, the least costly coverage, and then use theoretically the savings, because you're not spending a lot of money on the life insurance, but you get the protection you need. Then you could do the other things like building wealth, like your clients who want to invest in real estate, put money in 401ks, IRAs, college funds, pay down the mortgage, build up your bank account, all of those other things. So philosophically, I believe in buying term and invest the difference. And with that cost factor, a few cases we've worked on is I have an individual, she's a doctor, 45 years old. We got her $1.25 million worth of 20-year term insurance. So that means for your listeners that both the $1.25 million of death benefit and the premium is locked in for 20 years, and it costs a little less than $1,000 a year. We did another case for a 34-year-old mother of three, 34 years old, only needed $250,000 worth of insurance, and that's going to cost her $138 a year.
Wow.
Still another young man recently got married. They haven't begun having kids yet, but we talked about getting insurance in place. Now that they're married, they have a mortgage. They're probably going to start a family soon. He's 29 years old. He got insurance, Sean, that locked in the premium for 30 years. It was $450 a year.
Wow.
It's not a lot of money to provide protection and security if, God forbid, something bad happens. Yeah, probably they're wasting their money because probably nothing's going to happen and it's a waste, but it's not a huge outlay of money.
Well, but that's insurance in general. I mean, insurance in general is the one thing that we all buy that we never want to use.
That's exactly right. And this certainly falls into that category. I know in your practice, Sean, you have a lot of real estate investor clients. I'm a real estate investor myself, but for years now, I've gone into the marketplace and I've done flips before. I've built spec homes. I have bought properties that needed to be rehabbed and I would fix them up and then rent them out. And in some instances, I did creative financing. In other instances, I had partners in the deal. Well, if there was a night that I didn't come home, my wife, although she's very smart, would not easily be able to step in and perform the role I was performing in putting these real estate deals together. And that means then she would have to sell, possibly, and be a motivated seller. And I like to buy from people that are motivated sellers, but I don't want to be a motivated seller. And I wouldn't want my wife to be a motivated seller because I left a mess behind. And so for real estate investors, where you're doing deals, you're borrowing money, you have partnerships, creative financing, all those things, it's a great way to accumulate wealth. But those individuals should make sure that their loved ones are protected by securing life insurance.
Yeah. And I think also the other end of the listenership that I have, the people that want ideas to help them get out of debt, maybe they're in debt. I think life insurance is a good deal as well, especially the example I told about the friend of mine who passed with only $10,000 and not enough to pay off the loan. But think about, a lot of times if a husband and wife have joint debt and so the husband passes away, then how is the wife going to pay off that joint debt with the loss of income without a life insurance policy in place? I mean, right now, if something were to happen to me, my wife wouldn't have to worry about any of the debts that are in my name personally, because those would be gone with, whatever estate I would happen to have, which I don't think is much. I think I've got everything planned out properly. But to the extent we would have joint debt, she could use a life insurance to pay off that debt and then be secure in the fact that none of my creditors may come back and haunt her, because those joint debts, those things that she could be responsible for, would be paid off.
Yeah, very, very well said. And the other thing in the marketplace today is there's different types of life insurance policies. And I mentioned a moment ago that philosophically, I have always believed that term insurance is the best course for most people most of the time. My terminology with this is it should be term insurance unless there's a specific demonstrable reason why it should be something different. Those different policies go by different names, Sean. There's whole life, universal life, variable life, and so on. They are much more expensive per $1,000 of death benefit. Typically, they're going to be 10 to 20 times more expensive than term insurance for most people most of the time. I am not a big believer in those. And there's a debate out in the marketplace. There are some people that believe they are the right type of insurance product, but they're wrong. So a lot of what we do in the practice here at Elliott Wealth and the offer to your listeners is if you go for the 15-minute checkup, if you don't have insurance, we could talk about how much you need and the type, and we could help you work that out. If you do have insurance, though, we'd love to review what you have, because you want to make sure that you have the right amount of protection, that you have the right policy type, that you're not overpaying for the insurance protection. We also want to make sure that you have the correct beneficiaries. A lot of people have policies that they may have gotten a long time ago, but they may not have updated based on change in marital status or having children, or even accounting for the beneficiaries having moved or gotten married themselves. Make sure you update the beneficiaries. You want to make sure you're dealing with the strongest, most reputable insurance companies out there. So if your listeners have insurance and they're listening, please go to the site. We'll do a 15-minute checkup and make sure that you're getting a good deal with what you've already done in the past. And in a lot of instances, we could save clients a ton of money, and oftentimes not only save them money, but get them more coverage, the appropriate level of coverage, so that their family and loved ones are protected if, God forbid, the worst should happen.
Yeah. And I've got term, both of my policies, the one through the bar and then the one that I bought, are both term insurance policies. Although, I understand the counter argument is going to be that within the whole life policies, there is that investment component. And so you can borrow against it. You can, withdraw some cash value. So there is that, even though it's a more expensive product, there is that investment component to it. But if you're not using that investment component properly, you basically just bought yourself an expensive term policy.
That's exactly right. And also, in the vast majority of cases, when you build up cash value inside of the policy and then you pass away, your heirs get the death benefit, not the death benefit and the cash accumulation. So I just had a conversation with a client yesterday, and she has a variable universal life policy that she's had since 2011. So she's been putting money in it each month now for 8 years or so. And so we got what's called an in-force illustration to see how the portfolio, how the product is doing, and it's underperforming by every measure how it was projected to do when she got it. But what we looked at is by the time she's 65, I forget how old Jamie is, but when she got to 65, she'd have about $54,000 in cash value in the policy. This is a small policy, by the way. It's a $100,000 death benefit. But she'd accumulate $54,000 at age 65. So there you go. Like you said, there's a little pool of money that she could maybe use in retirement if she wanted. But if she passes away, she only gets the $100,000.
What happens to the 65 that was invested? Where does that go?
Well, the insurance company would tell you that that's built into the death benefit, but it makes no sense, because if she got term insurance and she took the difference in the premium, the term insurance would be less, and she took the difference between that and the higher premium she's paying to get the cash accumulation component of the variable universal life, would be the same if it was whole life or universal life or any of the other alternatives, and you passed away, your heirs would get both whatever that account grew to, whether it was in a mutual fund or a bank account or even a shoebox, and the death benefit. So typically, the way most of those policies are structured, you get one or the other.
I understand. I get it. Okay. So,
and let me just add one other thing is similarly, if you take out the cash because you need the cash, you have a real estate deal or you want to pay off some debt and you take the cash out of the policy, you're probably going to lose the life insurance.
right. Or maybe the death benefit payout is less if something should happen.
Correct.
Words,
So having them commingled, having them commingled is not optimal. What is optimal is decoupling, do your investing, your saving, your wealth building here, and now over there, get life insurance to protect your loved ones. There's very little reason in most instances to combine the two. It's a suboptimal decision.
Okay. I understand. I understand. That makes sense. So the one other reason I wanted to touch on real quick to get a term life insurance policy, to actually change your marital status. And so I know a lot of times people that get divorced may want to get, in my case, I got life insurance because I got married and I had someone I had to provide for. But also in the event of a divorce, you may want to get life insurance, or the court may require life insurance, by the covering the ex-spouse for much the same reason. In other words, if both ex-spouses are supposed to pay for college and one passes away and now you only have one spouse that can pay for college, maybe you have a life insurance, a term policy to help pay, college expenses or other expenses or whatever. So that could be another instance. Not only getting married, but getting divorced would be an instance to look into a life insurance policy. And then if you own your own business. So a lot of people that know me, that know my history, Yesner Law is mine. I own the law firm 100%. There's no other partners, no other members, shareholders, nothing. But before Yesner Law, I owned another law firm and I had law partners in that firm. And so one other reason that you might want to look at term life insurance, if something were to have happened to me, it's a little bit of a bad example because no one other than an attorney can own the law firm, but you could use life insurance on a business partner to buy out so that you're not now in business with your business partner's wife, and things like that.
That's very common. So, to extend on what you're saying, and this could be real estate or, two partners, they buy 100-unit apartment building or a big shopping plaza, and they're running and managing that property together. If one of them should pass away, would the surviving partner want to be partnered with the surviving spouse? And would the surviving spouse want to or have the ability to step into the shoes and have the same skill set as the deceased partner? Probably not. So the two of the partners could get life insurance policies on each of them. So if one of them passes away, they collect on the life insurance and then they have the liquidity without having to sell the building to pay off the surviving spouse. So you don't have to be partners with them, but you have liquidity, you have money that you could pay out to them without selling half the business or half the property.
Well, and this may be a tax question or an accounting question that's above both of our heads, but couldn't the business pay for the life insurance policy? So it's not a life insurance policy coming out of my pocket directly. Yes. It's a life insurance policy being paid by the business that would cover each of the owners in case something happened to them.
Well, fortunately, because I've been at this for 26 years, I know the answer to that question. And yes, the business can pay for it. But know this, that typically, if you pay for a life insurance policy, you pay premiums and you collect on the death benefit, it's not taxable. So I gave the examples of, Maggie and Ashley and Alan, that if they should pass away, their heirs would get that life insurance money. They would get it tax-free. If the business pays for it and they do not deduct it, they do not take it as a taxable business deduction, and there's a death claim, that money would go to the business tax-free. But if they deduct it and then there's a death claim, then the life insurance proceeds would be taxable.
Yeah, which makes sense. If you're going to get the tax benefit when you pay for it, then you're going to have to pay the tax on the other end.
Yes. Now, if you're dealing with a multi-billion-dollar corporation with operations internationally and the premiums are very, very large, it might make sense to deduct it. But, if it was you and I and the premium was, $600 a year just to make up a number, probably not going to deduct it. Just pay it out of pocket. And in the worst case scenario, then you would get the proceeds tax-free. But you're right. And what we talked about with this business arrangement with partnerships, it does fall into my original definition. The primary purpose of life insurance is to protect someone from a financial loss. And if we were partners in a firm and one of us passed away, the surviving partner typically has a financial problem because the person that died was probably doing something pretty darn important in that business that is not easily replaceable. And bringing liquidity and money into the business doesn't solve all the problems, but it does go a long way, including satisfying the heirs by having money in the business. Because a lot of times with a business, again, sticking with two partners, if one of them passes away, well, how does the surviving partner pass money along to the heirs? They would have to go out and borrow. But try and go borrow money when one of the partners just passed away.
Right.
How happy are banks going to be to do that, right? It's the old adage, borrow money when you can, because borrow money when you don't need it, because when you need it, they're not going to lend it to you.
Right. Okay. Well, again, if you want to get that free 15-minute life insurance checkup, go to elliottwealth.com, find the life button on the top of the page, click that button. That'll get you an appointment for a free 15-minute life insurance checkup. Chris, thank you very much. I really appreciate the relationship. I appreciate you being a repeat guest on the show. I appreciate your confidence in me and your support of my guests and my listeners. Unless there's anything else that we need to cover now, I guess we can put a wrap on this week's episode.
Yeah, I'll just say in closing, I love the title, Nobody Likes Life Insurance. But it is important work. Crushing Debt podcast. This is a way to protect wealth. And I don't wake up every day super excited about doing life insurance. I much prefer to talk about wealth building and achieving retirement goals and building portfolios of real estate and fattening my nest egg and building up 401ks. But life insurance is important, and this 15-minute checkup will be worth your listeners' time. So I really hope they take advantage of it.
Yeah, absolutely. Well, thank you again for being a guest on this week's episode.
Thank you.
And we will talk to you all listeners in next week's episode of the Crushing Debt podcast. So we are done there, and let me stop Zoom.